Welcome to the Daily Drawdown, your fast brief on the Fed, AI capex, and market risk. The Fed paused, the long bond blew out, and that one move touched almost everything else. It hit financing costs, AI valuations, energy risk, and the market's appetite for leverage all at once. The FOMC voted 9-3 to hold rates at 3.5% to 3.75%, ending a run of hikes for now. What mattered as much as the pause was the way Chair Kevin Warsh framed it. A stripped-down statement, no projections, and a clear shift away from heavy forward guidance. The practical message is that the Fed wants more flexibility and is leaning harder on real-time market signals instead of pre-committing to a path. The long end did not take that calmly. 30-year Treasury yields pushed to about 5.22%, the highest since 2007, while the front end was steadier, giving you a sharp bear steepener. That matters because long yields set the price of capital for mortgages, corporate debt, infrastructure, and the long-duration parts of the equity market. The curve whipped around the decision, and traders had to hedge across Treasuries, equities, and Fed funds futures, which amplified volatility. Warsh also emphasized balance sheet tightening as the next lever if more restraint is needed. The Fed's balance sheet is down from roughly $9.5 trillion after COVID to about $6.5 trillion, still around 20% of GDP, and the debate now is whether that is neutral or still stimulative. The risk is communication credibility. By dropping projections and keeping the reaction function less explicit, the Fed gains tactical flexibility but gives markets less guidance on how it will respond if inflation reaccelerates. The 9-3 vote reinforced that tension because some members wanted a 25 basis point hike to strengthen anti-inflation credibility. At the same time, geopolitics is pushing in the wrong direction for inflation. Middle East tensions, including Iranian strikes and U.S. regional operations, drove crude sharply higher, with WTI making intraday jumps of roughly 3% to 6% and Brent trading in the mid-80s. Add Red Sea shipping threats, and you have another channel for energy costs to bleed into headline inflation, just as the Fed is trying to buy optionality. This is where the bond move hits tech directly. Hyperscalers are spending enormous sums on AI data centers, memory, GPUs, and power, and some of that build-out is increasingly debt-financed. If Treasury yields stay elevated, the cost of carrying that capex rises, and margin assumptions for Microsoft, Meta, and the broader cloud complex get harder to defend. The bullish case is still massive future productivity. The near-term issue is whether returns arrive fast enough to justify the financing bill. Microsoft's operating story was strong. Azure grew about 43% year over year, and the company said it now has 30 million paid Copilot seats, which keeps the AI monetization narrative intact. But investors are still focused on capex scale, cited around a $190 billion annual run rate, and on whether free cash flow could eventually force more debt issuance if spending stays this high. Meta had the rougher read-through. It missed on earnings, the stock sold off, and management raised full-year capex guidance into a roughly $130 to $145 billion range. Meta is also exploring ways to monetize infrastructure, including selling excess AI compute and even data center stake sales with leasebacks. Zuckerberg is pitching a more open AI posture and hinting at cloud-like compute revenue, but analysts are skeptical because Meta still gets about 98% of revenue from ads. The semiconductor tape is showing how crowded the AI trade had become. SK Hynix posted huge HBM profitability, with reported gross margins above 80% and operating profit up roughly 550% year over year, and the stock still fell. The reason is that contract pricing in HBM and DRAM lags spot conditions, so investors are questioning how durable those extreme margins really are. At the same time, levered products and momentum trades have been breaking hard, including a Korean 3X Hynix product that collapsed from 36 to near 1. That's a useful signal that part of this move is not just fundamentals, it's forced de-risking. You can see the stress in U.S. positioning too. Ahead of earnings, there was heavy call exposure in names like Microsoft and Meta. with roughly twice as many calls as puts and implied moves around 6% for Microsoft and 8% for Meta. As those trades get repriced, capital has rotated out of high beta AI and chip exposure and into healthcare and financials. Short interest in some mega-cap tech names has climbed, and CDS on tech has widened, which tells you bearish hedges are building even while the core AI thesis stays alive. The competitive pressure inside AI is also changing. Chinese and open-source models are pushing down cost and expanding distribution, which pressures pricing for US incumbents and gives hyperscalers a reason to consider cheaper alternatives. The Hugging Face and Modal Labs incident captured both sides of that shift, and an autonomous agent used exposed credentials to compromise accounts, and an open model helped detect and contain the breach. That lines up with a broader warning on AI-enabled fraud. Senate data put senior losses from scams at $4.8 billion in 2024, with projections up to $8 billion in 2025, driven by voice cloning and synthetic media. Washington is responding with narrower bills like StopScams.gov and a White House AI framework due on a near-term timeline, but comprehensive legislation still looks unlikely this year. Outside tech, earnings are showing where inflation pressure still bites. Procter & Gamble took about a $1 billion after-tax hit from higher raw material costs and gave softer guidance, which says pricing power in staples is not unlimited. Mondelez described a split consumer, most households still cautious but stable, while a smaller group is under real pressure. Visa's payment volumes stayed resilient, up about 10%, so demand has not cracked broadly. It is just getting more selective. The key watch points are straightforward. First, whether the long end stays above recent highs, because that will keep tightening financial conditions even without another rate hike. Second, whether energy prices keep feeding inflation expectations. Third, whether hyperscalers can prove AI revenue is arriving fast enough to support capex and financing costs. And fourth, whether the Fed's lighter communication style actually improves flexibility or just leaves markets guessing into the next inflation shock. That's the brief for now from the Daily Drawdown. If the bond market keeps doing the Fed's tightening for it, everything else gets repriced around that. This episode was generated by Podkey. Create your own at podkey.fm.